What is a delisted stock? Delisting occurs when a listed company's shares are removed from a stock exchange, making them unavailable for public trading.
This process signifies that the firm becomes a private entity.
If a company's shares are still available on multiple exchanges but are withdrawn from just one, it is not considered delisting. The removal from all stock markets prevents individuals from investing in the company. Delisting can result from various factors, including bankruptcy filings, mergers, non-compliance with listing obligations, or the company's decision to go private.
There are two primary types of delisting: voluntary and involuntary.
Voluntary delisting happens when a company chooses to remove its securities from the stock market.
This may occur due to structural changes, expansion plans, or acquisition by an investor seeking a majority stake.
A company may also pursue voluntary delisting if it struggles to comply with stock exchange regulations that hinder its operations. In contrast, involuntary delisting occurs when a company is removed from the stock market against its will, typically due to regulatory action. This form of delisting often results from the company's failure to meet minimum standards, such as consistent financial losses, not maintaining required share prices, or failing to uphold necessary financial ratios and sales levels. Several reasons can prompt a company to delist its shares, including the intention to exit business operations, the risk of bankruptcy, mergers, or the failure to meet share price thresholds in compliance with listing requirements. Once a stock is delisted, it is removed from the exchange and may trade over the counter through a dealer market.
The shares still represent ownership in the company, but the stigma of delisting often indicates financial distress.
Despite the potential for relisting, which allows a delisted company to trade again on an exchange, the process is not common and involves adherence to various guidelines. Remaining listed on an exchange requires meeting specific criteria, such as maintaining price thresholds and sufficient market capitalization.
Delisting offers both advantages and disadvantages. While it may provide a failing firm with the flexibility to recover without public scrutiny, it also risks further financial distress and loss of credibility. The company can no longer raise public capital, and the perception of being delisted may erode customer trust.
Therefore, the decision to delist must weigh these potential benefits and drawbacks carefully.